Have you ever wondered how market trends can drastically affect your investment portfolio? Unseen forces, invisible yet potent, these trends shape the landscape of investing in ways that can either make or break your financial dreams. Picture them as the ocean's currents guiding the path of your investment ship. Market trends, be they bullish or bearish, are the collective expression of all investors' sentiments. They are the sum total of hopes, fears, insights, and speculation. Understanding these trends is akin to having a finger on the pulse of the global economy. Why are they important, you ask? Well, comprehending market trends allows investors to make informed decisions, to navigate through the choppy waters of the stock market, and ultimately to secure a profitable return. They provide us with insights into where the market might be heading, helping us to strategize and make the right moves at the right time. Understanding market trends is a key tool in the investor's arsenal. Consider the case of the dot-com bubble at the turn of the millennium, an era marked by the rise of internet-based companies, a phenomenon that took the world by storm. It was a trend that investors couldn't afford to ignore. The late 90s were a time of great excitement and optimism. The internet was still in its infancy, and the possibilities seemed endless. Internet-based companies, or dot-coms, were popping up left and right, and investors were eager to get in on the action. This influx of investment led to a rapid increase in the value of these companies, creating what we now know as the dot-com bubble. The bubble was driven by speculation rather than the actual value of these companies. Many of these dot-coms were startups with unproven business models, yet their stock prices soared to astonishing heights. Investors were betting on the future potential of these companies, driven by the belief that the internet was going to revolutionize the business world. And for a while it seemed like they were right. The bubble continued to grow, and those who had recognized the trend early on made significant profits. However, as with all bubbles, it eventually burst. By the early 2000s, it became clear that many of these dot-coms were not as valuable as their stock prices suggested. The market corrected itself, leading to a sharp drop in stock prices. Those who had failed to recognize the trend or who had held on to their stocks for too long suffered significant losses. The dot-com bubble serves as a stark reminder of the importance of understanding technology and market trends. It shows us that while trends can present lucrative investment opportunities, they can also lead to financial ruin if not approached with caution. Investors must always strive to understand the underlying value of their investments and not get swept up in the hype. This case study illustrates the potential impact of market trends on your investment portfolio. It's a lesson in the importance of staying informed, making calculated decisions, and understanding the risks involved in investing. So, how exactly do market trends impact your investment portfolio? Well, the relationship between market trends and your investments is a fascinating dance. Market trends, whether they're bullish or bearish, have a direct effect on the performance of your investments. In a bullish market, where prices are expected to rise, your investments can grow and yield impressive returns. However, the opposite holds true in a bearish market, where falling prices can lead to potential losses. But here's where it gets interesting. These trends don't just create risks, they also create opportunities. For instance, a downward trend could be a golden chance to buy stocks at a lower price, potentially leading to higher returns when the market rebounds. Conversely, an upward trend might be the perfect time to sell and secure profits, yet riding the waves of market trends requires a balanced approach. This is where diversification comes in. By spreading your investments across different asset classes, sectors, and regions, you can mitigate risks and potentially improve returns. It's like putting eggs in different baskets. If one falls, the others are still intact. Staying informed about market trends is also crucial. Understanding the market's direction and the factors driving it can help you make informed investment decisions. It allows you to anticipate changes, respond proactively, and ultimately protect and grow your portfolio. Your investment strategy should always consider the current and anticipated market trends. In conclusion, market trends can make or break your investment portfolio. From the dizzy heights of the dot-com bubble, we've seen how market trends can profoundly shape the fate of investments. Staying informed about these trends and considering them in your investment decisions is not just prudent, it's essential. Knowledge is power after all, and in the investment world it can mean the difference between success and failure. Remember, the wise investor is the one who understands and anticipates market trends.